Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And about 6 months ago, I can't believe it's been that long, I came out with a video called The Great 8, the one you're seeing on your screen. And by the way, if you just put The Great 8 in YouTube, you'll probably get my video and a bunch of Alex Ovechkin videos or video clips. But anyway, the point of this video, The Great 8, was really to tell you the funds or the ETFs that I feel you could buy and hold forever that could make up the core of your positions or the foundational core pieces of your income portfolio. The common thing between these Great 8 is they're all ETFs. They're all covered call based or income based. They're all diversified. So I know many of you are going to ask me, what about bank and what about this sector one and the Bitcoin one? These are all going to be diversified and they're all going to use a little bit of leverage. You guys know that my favorite type or format of fund is covered calls with a little bit of leverage. In the Canadian stock market it's a very popular concept and many providers have this, and it's only 25% leverage. One of them has 33, but it's mostly 25% leverage. And why this is so powerful, of course, is because it mitigates, or it helps to mitigate rather, the yield return trade-off. We know that when we're doing covered calls on something that is a good quality asset and that go up over time, you're capping your upside. You're missing some of that upside, which means you're going to underperform the exact same asset without the covered call. So that 25% leverage really helps you boost your performance over time. Of course, this increases your volatility in the short term when there's a big drop, but over time, leverage is going to be your friend. Especially now that interest rates and leverage costs are so cheap, and also especially that this is not margin or leverage you're borrowing yourself. This is the fund managers who's doing it, who's managing it for you, and they get the best interest rate. So to me, the greatest funds, the Great 8, have to have that leverage. But of course, we'll go through a few honorable mentions that don't have the leverage. But in my personal opinion, guys, if you're going to be a long-term income investor, hold something for many years, I can't see why you wouldn't have it with the leverage, but hey, that's just me. So let's go through the now Great 10, because I have to give credit to where it's due, and there's going to be the Great 10 instead of the Great 8. So let's go through them together right now. I'd like to thank Moomoo for sponsoring this video. Moomoo is a newer broker Canadians have access to, and they always have big bonuses for new accounts. Just make sure to use my affiliate link in the video description below. You got to see the PII/Moomoo at the top of the page. For example, if you open a new account, there's deposit bonuses. Example, you deposit $5,000, you'll get a $300 stock cash coupon, which is like a gift card to buy stock with. A bunch of other bonuses you could sift through here. And if you're like me and you're just into dividend stocks, dividend ETFs, for example, QQCL is one of my biggest positions. Moomoo is a great app to visualize all this stuff. So you could get detailed dividend information, dividends per share, dividend yield, dividend history, etc. And if by chance you're interested in trying out writing your own options, I don't personally do that. I invest in covered call ETFs, but if ever you want to try selling or writing your own options, you could do that with Moomoo. It's a great platform to do it. Just like you could see here with the Apple stock example, it's a fantastic app that's very intuitive and easy to do if ever you want to dabble in that. And remember that Moomoo has one of the lowest commissions for Canadians who want to trade US options, right? Only 65 cents per contract, which is lower than Questrade and Wealthsimple. So you could always give it a shot if you feel like it. So again, guys, on top of all these bonuses, by the way, if you open a new account, users that use my specific link will also get an extra bonus, a $30 Amazon gift card if you deposit $1,000. So try it out, open a cash account, do a little deposit, get a lot of these bonuses, and maybe try out options if you feel like it, if you're brave. Moomoo is a great platform. Right, kicking the list off, and this is in no particular order, right? I'm not going to tell you this one's better than this one or this one is the best. That doesn't exist in investing. Obviously, you guys know which ones are my favorite because I hold them. I actually hold several or 4 of the Great 10 in my personal portfolio, including HYLD, the first one, or HYLD from Hamilton ETF. So this is, to me, I regard this as an S&P 500 covered call ETF with 25% leverage. It's not exactly the S&P 500, but the combination of the ETFs inside of it, which are all now Hamilton ETFs as of February 2024. Basically, it's like investing in the S&P 500, guys. Okay, it's not exactly the S&P, but it kind of is, and it has that 25% leverage. Also, one thing to note is that this one is hedged to Canadian dollars. Okay, they do have an HYLD.U version, so this one is still on the Canadian stock market, so you don't have to worry about that 15% withholding tax, but you do have to buy it, sell it, and get your dividend in USD currency. So that one is unhedged to the Canadian dollar. HYLD is hedged to the Canadian dollar, which means that if the Canadian dollar gets weaker, that could hurt HYLD, but if the Canadian dollar gets stronger, that will help HYLD. Okay, so this one basically, when you're gonna do, and by the way, this is just a tip for all of these, when you're trying to decide, okay, which of these 10 should I have in my portfolio, a big thing to know is, of course, the number one thing to know is what you're investing in, and of course, total returns, right? You always got to you should use this tool. This is a great tool where you could compare two ETFs, and it will automatically take the good starting date, the later starting date of the fund that came out later. So you'll have when you do a total return comparison, you always have to use the same start date and end date. So this is a great tool to compare, see how all of these great 10 are not only doing versus themselves, but also towards something that you could compare it to. So HYLD, what you're gonna want to compare it to is the S&P 500 hedged to the Canadian dollar. So always do HYLD versus VSP, right? That's the Vanguard S&P 500 in Canada, hedged the Canadian dollar. And another thing, very important thing to note, is that HYLD really became HYLD like we know today as of approximately February 1st of 2024. So when you're doing the total return comparison, remember that HYLD was completely different back then. It had a bunch of third-party funds. It's much, much better. So the HYLD version 2 that we all love, this is, started in about February of 2024. So for example, I would always compare HYLD to VSP just to see how it's doing to its equivalent, kind of, the S&P 500, but I would always choose a starting date of February 1st, 2024, because that's when HYLD really became HYLD that we know today. And you could see that it is actually doing very, very well. It's pretty much on par with VSP, which is actually pretty incredible considering the steep drop. Remember, HYLD has 25% leverage. So with dividends reinvested, it's right there. With dividends not reinvested, so for example, if you're just spending the cash, it's actually outperforming VSP. So very important, guys, always do the total return comparison using this tool when you're trying to assess these funds. So HYLD, number one on the list. To me, it's an S&P 500. It's hedged to the Canadian dollar. It's one of my personal core positions. Next one is HDIV. This is actually the OG, the original fund that came out like an all-in-one with covered calls, 25% leverage. This one also has transformed over the years. It kicked out all its third-party ETFs, and now it's just Hamilton ETFs. This one is actually very, very unique. I really like this one. I'm actually thinking of reintroducing it in my portfolio because it's so damn good. So this one has all Hamilton ETFs, but not all of them are covered call. You have HFIN and HUTS that are not covered call, but are also leveraged. So they're leveraged growth ETFs. The rest are covered calls. A lot of the same, some of the same ETFs that are an HYLD. But this one is really going to be more geared towards Canada. It's kind of like an 80% or 75%, something like that, Canada, and then the rest in the US. You do have some US exposure. For example, with QMAX here, you also have some US exposure in EMAX. There's a lot of US energy companies in there. LMAX, which is a very small position, and also RMAX, real estate. There's some US stuff in there. There's also some US bonds as well, just a little bit here. So this one really focuses more on Canada. So this is a good one if you kind of want North America, a little bit more focused on Canada. You see the breakdown here. Canada is very heavy on what we all know, financials, energy, gold, utilities, which is the top here. And sorry, I forgot to show you HYLD. You'll get a classic. It'll look like an S&P 500 style, right? So technology is always about 30%. Then you have about 12, 13 in healthcare and tech. So this is definitely kind of, trying to mimic the S&P 500, where this one, the goal, as stated at the top, is broadly similar to the TSX 60. That's the Canadian S&P 500, if you will. So this is definitely more geared towards Canada, but with some US in here as well. And this one has really been doing really, really well. It's at the top in terms of its competition. There's, two direct competitors. It's beating its direct competitors, which I'll tell you about in a bit. But this one's just been doing extremely well. It never reduced its dividend. It's only increased it. It's absolutely phenomenal. Great track record now of over 3 years. Moving on to number 3, it's HDIF. This is Harvest's diversified all-in-one. So this will include all of Harvest's, or many of Harvest's covered call ETFs, a lot of which are sector-based. You see the breakdown here. It's a nice little balance between financials, tech, healthcare, utilities that has a little bit of everything, even real estate and consumer staples, etc., etc. This one is also Canadian currency hedged. The current yield's about 11.5 on HDIV, by the way, I forgot to mention. It's about 12, a little over 12 right now. So a lot of these ETFs are going to be in that magical range of 12 to 15, something like that. There's one in particular, which we'll see soon, which is much, much higher than that. And it's the new addition to the list. But going back to HDIF here, this has been around for a really long time. It's never reduced its distribution as well, which is a good sign. It's raised it a little bit. So this is really, if you want, the best of Harvest, if you will. HBIE is another one from Harvest. And by the way, in case I did mention it, all of these are leveraged 25%. Okay, guys? HBIE is really if you are an income investor, a covered call investor, but you really want that 60-40. If you really want 60% stocks, 40% bonds. You guys know that that's not my favorite type of fund. I always go 100% equities, but many of you still like that classic 60-40. So this is kind of like a 60-40 version of HDIF, kind of. So if you look at the portfolio, it has about 10% yield, something like that. So it's going to have a lot of the same ETFs that HDIF's going to have, but you'll also have some of those Harvest covered call bond ETFs as well. And some of them are non-covered call as well. So this is really designed to give you about 60-40 but income and covered calls, and it has 25% leverage. Now the new one to the list, and this is personally my personal favorite Harvest product right now. You guys know that it's also one of my core positions. It's HHIS. So this is the Harvest Diversified High Income Shares ETF, everyone. And basically what it is that, in case you didn't know, Harvest launched their own line, a new line called the Harvest Enhanced High Income Shares, which is basically ETFs that have only one stock and do covered calls and that have 25% leverage. So right now they have 14 of them out. They have Lilly, Amazon, Microsoft, Nvidia, Palantir, Tesla, Meta, AMD, Broadcom, Coinbase, Costco, Alphabet, and MicroStrategy, Netflix as well. I'm sure they're going to come out with more of them, but HHIS basically is an all-in-one for those. Okay, it combines up to 15. So the latest press release said that HHIS is going to have up to 15 of Harvest's high income shares. Right now it has 14 because there's only 14 out, right? It basically has an equal weight of all those companies I mentioned. And the yield is absolutely astronomical with this one. Why? Well, because with these are single stocks that are typically a bit higher volatility, right? These are US tech stocks. Some of them are extremely high volatility, which means they could generate a lot more yield, like Palantir, Tesla, AMD, Coinbase, especially the MicroStrategy. That's the highest yield one, or now Strategy. So of course HHIS is going to be much, much higher yield, obviously higher risk than, let's say, an S&P 500 or NASDAQ 100. But because it's, Harvest has selected a lot of these innovation companies, you have higher volatility, which means higher yield. So right now the yield's actually about 29%. So you got to expect probably fluctuating dividends as well. Excuse me. So far 3 distributions have been declared. The latest one for the payout in May is not listed here, but it's already been declared at 25 cents. So very, very consistent here. Hasn't been out for a year. But again, this is going to be a combination of up to 15 of Harvest's high income shares. And my prediction or my assumption is that they're going to come out with many, many more of these single stock covered call ETFs. And I think the top 15 highest yielding ones are probably going to be in HHIS. So I think HHIS is going to, on the Great 10 list, by far is going to have the highest yield out of everyone. It's going to have, it started with a yield of 25%. But again, if, this is an amalgam or it's a combination of these. So if some of these increase or decrease, that's going to have an indirect impact on HHIS. So if a lot of them decrease, HHIS is probably going to have to reduce its distribution. I'm just guessing here. But if some increase, some decrease, maybe HHIS will keep it the same, just like it has this month, like I'm filming this, right? Tesla has decreased the distribution, for example, but Palantir MicroStrategies has increased it. So it's going to be always an amalgam of what those 15 or soon to be 15 probably single stocks are doing rather. Next one is USCL and QQCL and EQCL. So these are from Global X Canada. So USCL, the best comparison you could pretty much do is with HYLD. A couple of major differences. One, USCL is legit and officially the S&P 500. HYLD is not. Also, this one does index call options, so it's writing S&P 500 index calls, whereas HYLD, they're doing call options on the stocks inside of these, right? So they're doing actually stock, single stock cover call, if you will, while this one is doing index calls. And also the third difference is that this one is not hedged to the Canadian dollar. So this is why USCL has been outperforming HYLD lately, because there's been pressure on the Canadian dollar. But of course, if the opposite is true, the opposite's going to happen. So if the Canadian dollar starts getting stronger, that helps HYLD but hurts USCL a little bit, but the opposite is also true. So obviously the strength of the American dollar versus the Canadian dollar has helped USCL tremendously. So this one is basically 125% of USCC, right? We know that Global X has done something really cool. They basically they have leveraged and non-leveraged versions of everything almost now. So USCC is their S&P 500 cover call ETF. Add the L or change the last C to an L, and you get the 25% leverage version, enhanced version, which means more yield, obviously, but 25% more volatility. So this is a pure S&P 500 cover call ETF with 25% leverage, and this is also the third core position in my personal portfolio. You guys know I love this one. You guys know I love the S&P 500. So the combination of HYLD and USCL for me makes up my S&P 500 position. So the distributions have been really, really good. They started at 23 cents. They raised it to 25.5 cents, but have now lowered them back to 23.5 cents. So it's 23 cents to 25.5. Now it's at 23.5, the latest distribution, which just proves that the fund manager is doing the responsible thing and wants this to be sustainable. Another thing I forgot to mention for HYLD and HDIV, they always hold back 1%. They hold back a little bit of income. They have a 1% cushion to make sure that in case there's big drawdowns, they could keep the distribution of HYLD and HDIV very consistent. And that's actually, even though the S&P 500 has dropped recently and HYLD has dropped recently, they were able to keep the distribution the same, but USCL had to reduce a little bit, right? If you're doing S&P 500 index calls, guys, even with the 25% leverage, and remember that these guys, most of the Canadian fund managers don't surpass 50% covered calls, right? They're never going to do past 50% of the portfolio. It's impossible to really go with 16-17% yield, right? So they had to reduce it, and right now the yield's at a more sustainable 13-14% yield right now, something like that. So that's USCL. That's the next one. QQCL is the fourth one on this list. That's a core position in my personal portfolio. It's a NASDAQ 100 covered call ETF. So they have QQCC, the non-leverage version. This is QQCL. So exact same thing, exact same strategy as USCL, except it's on a NASDAQ 100 index. So this one also, the distribution was 25 cents a month. They raised it to 29.5 cents in the last couple of months because the NASDAQ has been doing so well. But now with the latest drop, they reduced it by a small amount, by 2 cents, to 27.5%, right? So again, if you're doing NDX or NASDAQ 100 index calls on up to 50% of the portfolio, 17-18% is not sustainable, guys. So again, right now it's about more the 15% yield mark, which is a lot more sustainable. So these are, you know, QQCL, USCL, and HYLD in the list are really going to be your S&P, NASDAQ ones. You guys know those are my two favorite indexes. So obviously that's why they're in my portfolio. So again, these are just monthly pairs that you could buy and hold forever. Good quality assets, a little bit different between all of them here. With monthly distributions as well that could go up or down based on volatility and net asset value. EQCL definitely makes a list. So you guys know what XEQT and VEQT is, right? The all-in-one. Let me just get the best stocks all around the world using indexes. This is like a covered call version with 25% leverage. So they have EQCC, which is the covered call version without the leverage, but of course you guys know that to make it in the grade 10 you got to have a little bit of that leverage. So EQCL is basically a combination of Global X's covered call ETFs on indexes. So here's the S&P 500, which is the biggest position, which is basically USCC, USCL, guys. Here's the TSX 60, NASDAQ 100, Russell 2000. So that's going to be your North American exposure. But you also have some emerging markets, and you have the MSCI EAFE, which is Europe, Australia, Australasia, and Far East. So this is basically, give me the 100% stocks in the whole world via very popular index funds, but give me the covered calls on them and the 25% leverage. So this is a super all-in-one if you want the whole world. Also some very consistent distributions. They started them at 21 cents, then they raised them to 22.5, and I think the latest one was 22 cents. So this basically is like a one-stop shop for the whole world. So you have about 50% in the US, 20% in Canada, and 33% in the rest of the world. Moving on to number 9 is BMAX. So BMAX is Brompton's all-in-one. This one, and in typical Brompton fashion, not the highest yield, but really a good focus on quality and sustainability. So this one, the yield's about 10.5. What makes this one really unique compared to all of them is two things. One, it's multi-asset. So just like HBIE. So HBIE, sorry, let me just close these tabs here. HBIE and BMAX are the only ones on this grade 10 list that have some fixed income in it. So BMAX has about less. Well, first of all, let's talk about the leverage. So it's the only one that has 33% leverage instead of 25. Okay, instead of 25. And then it's also multi-asset. So this is going to be a combination of a bunch of Brompton's covered call ETFs like this one, North American Financials, Technology, Global Dividend, Global Infrastructure, Europe, Healthcare, low volatility. But it also has about 25% in fixed income style securities, 10% of which is in SPLT, a great low volatility ETF that gives you access to all the split share fund preferred shares in Canada. So this is very low risk. And then you also have preferred shares in the US. So that 25% in fixed income is really in these two ETFs, 1 and 2. Hopefully my face is not blocking anything. And then the rest are your Brompton covered call ETFs. So distributions have been really, really steady, if not increasing. Right now it's at 11.5 cents, but it used to be a bit lower than that. I believe it was at 10.4. So very good sign, very nice mix. Also has a bit of global diversification, right? You got the Europe one in there. So you could see the breakdown here. Sorry if it's small. 82% North America, 17% Europe, a little bit in Asia, and then you also have the portfolio here. You see that 25% fixed income. The rest is in stocks and equities, and you have very, very good diversification across the sectors here. So another great all-in-one here. So if you're let's move on to the next one. I just had to add this one back in. I know it's not an ETF, guys, but it's just so damn good. I had to add EIT, the Canoe EIT Income Fund back. This is actually a closed-end fund. Okay, it's not an ETF, but it's really, really good. You see that right now it's even trading at a discount. It has the lowest yield out of all of them at 8.1%, but this is because the dividend has been 10 cents a month or $1.20 annually for a really long time, over 10 years. I don't know if they're going to raise it or not, but this one's kind of set up like a split fund. It's just not called or a split fund, but it's literally been set up like one. It has two preferred stock symbols, and it has the core one, the class A, I guess you could say, or the capital shares, which is EIT.UN, and this is the one that's really part of the grade 10, not the preferred shares. But I believe that each of these preferred shares grants 10% leverage each to EIT. So EIT.UN is leveraged 20%. So 8 of the 10 is 25%. BMAX is 33. EIT a little bit less at 20. What makes this one special is its defensive nature. It actually does not have a lot in technology. It has very low weighting in technology. It has a lot of mostly in financials and energy. This company, Canoe Financial, really believes in the energy sector. So energy has always been a big sector here. And it mostly invests in quality blue chip dividend growth companies or growth companies. So you see the breakdown here. It's about 50% Canada, 40% the US, and a little bit elsewhere. There's 47 stocks, so it's pretty concentrated in high quality blue chip stocks, guys. And these, I don't know what it is, but this guy, Robert Taylor, just knows what the hell he's doing. It stayed really, really strong during the latest volatility. And it's just great. I mean, the performance speaks for itself. You could look at the performance. You see that in the last 10 years, the average annual return is 11.65, which is really amazing considering it has a lot in Canada, right? In the last 5 years, you see 3 years, 1 year, 6 months. I mean, it's all amazing, stellar performance. The yield is not incredible at 8%, but very, very good one. So I had to add it to the list. I would be remiss. So before we go into the honorable mentions, and there's a lot of them, I just want to tell you, or if you're wondering, okay, which of the 10 should I choose for my foundational core positions? Well, guys, I'll give you my thoughts, but again, it's really up to you, and it really depends on the type of investor you are and the assets you want. I will tell you right off the bat, if you're more of a conservative investor, maybe you're a retiree, you're not just aggressively going for yield, although I think the yields are very well sustainable for all of these. I think in terms of defense, the top 3 defensive ones would definitely be HBIE, BMAX, and EIT. I think these 3 are going to have the least amount of volatility and fluctuation out of all of them. HBIE and BMAX, pretty straightforward. It's because they have fixed income in there. EIT is just because it's a little bit more of a defensive portfolio with more quality value stocks and less like technology type stocks, which could be a little bit more volatile. So those are the 3 I would consider or look at to make a position if you want a little bit more less volatility and more defense. But not to say that the other ones are not good as well. Also EQCL, right? If you want this one's very unique because it gives you the whole world. BMAX, you have some global diversification in here. The rest are kind of mostly focused in the US, Canada, North America. So if you're looking for that exposure outside of North America, I think BMAX and EQCL are good ones to consider as well. Now, if you're like me and think that the US stock market, S&P 500, NASDAQ is really the best, well then HYLD, USCL is going to be the ones to consider for your S&P 500 position. Again, the main differences between them is that USCL is actually the S&P. It's not Canadian currency hedged. And it's index call options versus stock call options, what HYLD does. But I just like both of them so much that I have both of them. For your NASDAQ 100, QQCL is just the king. Doesn't really have much competition. It does have some competition without the leverage. There's QQCC. There's Invesco has one. But last I checked for the total returns, QQCC and QQCL are doing the best ones. Just a reminder, if you're looking at the total return of QQCC, that used to be, just a side note, QQCC used to been around for a long time, but it used to be a completely different ETF. So you got to ignore the performance of that. They just renamed the ETF from like international exposure and they changed it to NASDAQ 100. But QQCL started with, the NASDAQ 100. So obviously, if you like the S&P and the NASDAQ, you believe in US stocks like I do, these are my favorite way to invest. HYLD, USCL, QQCL could definitely be core building blocks of your portfolio. HDIV, again, very unique. Performance is amazing. In my opinion, the three that are competing that are similar in terms of breakdown and regional diversification would be HDIV, HDIF, and BMAX. I think those three are really competing against each other. If you look at the total returns between the three, HDIV is by far the winner. It has the best total return by far. So yeah, this is very unique because it's not fully income. There's some growth in here. And also it's North America as well. You have mostly Canada, but you have some US in there as well. But HDIV kind of, similar style, except it's all income. It's all covered call. And BMAX, also has some diversification between Canada, US, and international. But between the three, and all three of them are great. All three of them have, leverage and the same factors, consistent monthly income and quality stocks, et cetera, just to say that HDIV has the best total performance. HHIS is by far the highest yielding one. It's my favorite new harvest product. So this one really, the way I look at it is a concentrated NASDAQ 100. A lot of these 14 stocks really make up the big portion of the NASDAQ 100. All of them are NASDAQ stocks except for Eli Lilly. Very, very technology focused. So another thing that really stands out to me, it has the lowest fee out of all of them, by the way. No one didn't cover the fee, so let's go through it. 65 basis points, 65 basis points. And I'm saying 65 because most of the ETFs, they actually have 0, but they're subject to the fee of the underlying ETFs, right? So most of the ETFs of Hamilton ETFs are 65 basis points. So that's why I'm saying HYLD and HDIV, I guess you could say, has 65 basis points. HDIV, same thing, 0% fee on top, but most of the ETFs are 65 basis points, maybe a little bit more, maybe a little bit less. You see, again, 0 management fee. HBIE, same concept. I think 0 fee on top, subject to the fee. Yeah, subject to the fee of the portfolio. HHIS, same thing, 0% fee, subject to the fee of the single stock ones. But what's interesting is that they all have 0.4% management fee. So out of all of them, the highest yield one actually has the lowest fee, which is pretty crazy. USCL is 65 basis points. QQCL a little bit higher at 85 basis point management fee. And I'm looking at the management fee, not the MER. Remember, the MERs on all of these are going to be very high because it includes leverage costs. I keep getting the comment in question, why are these MERs so high? It's because they include the leverage costs, guys, okay? They include the leverage costs. EQCL is 75 basis points. BMAX, what is the BMAX one? Okay, well, it's 0% because it's all BMAX ETFs inside, so it's all subject to the Brompton ETFs inside. And you have EIT, which I believe is what is the management fee? I think it's on the higher end. It's 1.1, but hey, well deserved if you ask me. So just wanted to go through those management fees. And again, guys, that's how I see all 10 of these. They're all great. No one's better than the other. In my opinion, it's really what's best for you, what's better for your portfolio. I like all of them. HHIS is, I have to admit, is probably the new product of the year because of its yield and low fee and just simplicity. It's just awesome. But again, if you're trying to decide, if you're trying to evaluate them, always look at the total returns as well as the composition and see what's inside, because that's what you're really investing in. So now moving on to some honorable mentions. All right, guys, as far as honorable mentions is concerned, this was really a tough one because I added EIT in there, but not GDV. GDV could have been the grade 11, to be honest. So GDV is what I feel is one of the most well-rounded, well-diversified split share funds from Brompton. Absolutely phenomenal stocks in here. Global dividend stocks, so dividend stocks that grow their dividend over time. Almost 80% in the US. So these are mostly high quality blue chip. They're all high quality blue chip dividend grower stocks, mostly in the US, a little bit in Canada and a couple of other places. But this one just has a phenomenal track record of performance. Been around for over 5 years, has not missed a dividend. Unit NAV well over $20 at a little discount right now, 12% yield, just under that. So the only reason it hasn't been in, I guess, is because it's not an ETF, I would guess, to say, but EIT is not an ETF either. But GDV definitely could be a very strong core position, foundational position. Just remember that it is a split share fund. So if it goes under $15 unit NAV, it will stop paying until it recovers, but it never has done so, and I really doubt it will, just because of the high quality defensive nature of dividend stocks in general. Another contender, and this is the only reason that this one is not in the list, this is an ETF, it's just because it's brand new, we don't have really a track record for it, is CLSA, Class A. So this is the Brompton Split Share Fund all-in-one. This is an all-in-one Class A share split fund. So this is kind of like the Class A version of SPLT, which SPLT, very popular from Brompton. That's the all-in-one a preferred share split fund, which is actually inside BMAX. Maybe this one's going to be added to BMAX. Who knows? I would definitely like for it to be added to BMAX. But this one is basically an ETF, and it's always going to have a monthly dividend. So check out the video in case you haven't seen it. I talked with Michelle and Chris about this ETF in detail. Their goal is to have about 12% yield, never miss a dividend, and give a little cushion in case things go south and a lot of the split funds stop paying dividends, for example, temporarily. So this one's going to have all or most of the split share funds, Class A shares in Canada, mostly with the big ones. So Dividend 15, Life and Bank, just LBS, FTN is here, ENS, FFN, DGS, GDV's there, this is SBC, this is BK. So you have most, if not all, the big Class A split funds. This is definitely an honorable mention. Could definitely be a core foundational position. It's going to be very heavy on the financials. Keep that in mind, though, because a lot of the Class A shares or split funds in Canada focus on the financials. Another honorable mention could be CNCL. So, I did put USCL, S&P, QQCL, the NASDAQ, EQCL, the world. But there's also CNCL, which is the TSX 60. I guess if you want an all-Canada one, this could be definitely an honorable mention. I do like the fact that there's leverage in here. And there's a bunch of honorable mentions that are not leveraged as well. I wanted to do like a non-leveraged version of this video, but hey, the great ones have to be the leverage version. But still, if you're just not comfortable with the leverage, guys, keep in mind that most, if not all of these have non-leveraged version. HDIV has HRIF, HBIE has HBIG, HHIS doesn't have one. But USCL, it would be USCC, QQCC, EQCC, etc., etc. BMAX does not have one. HYLD, I guess if you really like Hamilton, you want something non-leveraged, the best one would probably be SMAX, right? Which is, kind of like the 20 concentrated S&P 500 without the leverage. So there, obviously, the non-leveraged versions for, if there is for these, could be definitely honorable mentions. There's other ones as well. There's SPX for your S&P 500. This is a competitor to USCC, the non-leveraged version from Evolve. Very high yield, hasn't missed a dividend. There's also JEPI and JEPQ. JEPI I don't really like. I'm going to make it part of this list because you guys know it's not really the S&P 500. I would always prefer an ESPX or USCC if you absolutely want a non-leveraged S&P 500 covered call ETF. But the JEPQ is much better in my opinion. I guess it could be a competitor to QQCC if you absolutely want a non-leveraged version, but I think I'd rather fancy QQCC. FEPI is another one from Fidelity, which is an alternative to USCC or ESPX if you want an S&P 500 non-leverage. What's good about this one is the fee is low. It's about 8-9% yield. It's a rinse and repeat strategy, 2% out of the money. every single month. That could be another one. I know many of you like PDIV from Purpose. This could be a good all-in-one to keep that has no leverage. It has Canada and the US. However, if you do some total return comparisons, you see, for example, it greatly underperforms HDIV. But hey, just throwing it out there, PDIV. There's other ones too. There's ZWQT. This is BMO's all-in-one, although I like their ZWG ETF more than this. Very low yield, but I guess it could be a contender as well if you don't want the leverage, but very low yield. Again, guys, the most important thing is to assess and really figure out what's best for you based on what you're investing in, fund manager, track record of dividends, and of course, total return. Always make sure you're doing the total return using this really nifty tool where you could do the total return comparison between two ETFs. So hopefully this was informative for you guys. Give me a thumbs up. I would really appreciate it. Did I miss anything? Let me know. And by the way, if you're wanting the American version, I know I did a grade 10 or grade 11 on the US side, but now with so many amazing S&P 500, NASDAQ 100 covered call ETFs, well, I think what I'm going to do for the US side for my American friends, or if you're Canadian, you investing in income stuff in your RSP, don't forget there's no 15% withholding tax in the RSP or your Lira. I'll probably come out with an episode of like the great S&P 500s or the great NASDAQ 100s that you could buy and hold in the if you invest in the US stock market. So guys, I'm out of breath. Again, hit that like button. I would really appreciate it, and see you next time.